In this video we're going to look at the emergency tax basis and USC deduction for somebody in 2019. The standard rate of tax is 20% and the higher rate of tax is 40%. Where an employee does not provide a PPS number, all the money will be immediately taxed at 40% and there's no tax credit, so they will pay the full 40% in their tax, and the USC is 8% on the full amount. Where an employee does provide a PPS number, for weeks 1 to 4, there is a weekly cut-off point of 679. So up to 679, they would pay at 20%, and the balance would be at 40. But there is zero tax credit, so whatever amount you work out, they would automatically be paying it in full. From week 5 onwards, there's no weekly cut-off point, so immediately all the money will be taxed at 40%, and again, there's zero tax credit, so they will pay all of that in tax. Down further, you will see about the USC. So remember, the USC for the entire time they're on emergency, and only when they're on emergency, the USC rate will be 8%, unless revenue tell you otherwise. Compare that to 2018. So again, the standard rate of tax and higher rate of tax were exactly the same, and similar to before in 2019, where the employee does not provide a PPS number, the full of their money will be taxed at 40% and no tax credit. However, where the employee does provide a PPS number, weeks 1 to 4, there is a weekly cut-off point of 665, up to which they are taxed at 20%, but then you would minus a tax credit of €32 for the first 4 weeks. From week 5 onwards, there's still a cut-off point. Now compare that to 2019, where there's only a cut-off for the first 4 weeks. Weeks 5 to 9, 665, but there's zero tax credit. So up to 665, they will pay 20% and the balance at 40%. From week 9 onwards, they will pay 40% on everything and there's no tax credit. And again, remember, the entire time that they're on emergency, they will be paying 8% USC on the full gross amount. So here we're going to look at this person has after starting on week number 5. So it's their week number 1. They earned €500. For the first 4 weeks, the cut-off point is 679. So what you do is take the smaller number, which is the 500, multiplied by tax rate 1, which is 20%, that's 100. Nothing at the higher rate, so that's 100 in total, but there are no tax credits, so they pay the full €100. And remember, over here for USC, it's 8% all the time they're on emergency, so 8% of €500 is 40. Week 2, it's similar, €500, a cut-off point of 679, again 500 multiplied by 20% is 100, and then no tax credit, so they pay the full €100. The third week, €600. 600 is still smaller than the cut-off point of 679, so the smaller number 600 gets multiplied by 20%, and that gives us 120. Again, there's no tax credit, so they pay the full 120. And again, over here, it's 600 multiplied by 8% for the USC. For the fourth week, they earn €900. Now this time it's bigger than the cut-off point, so the first 679 is multiplied by 20%, which gives us 135.80. The balance, so that would be €900 minus the 679, you multiply that by 40%. And on the computer, you add the two of those numbers together, you get 224.2, and again they pay the full of that, and 8% of the €900 is 72. On the following week, €500, there is zero tax credit. So on their week 5, which is our week 9, there's zero of a cut-off point and zero tax credit. So the €500 gets straight away multiplied by 40%. There is no rate 1. €200, they pay the full €200. Down here for the next week, €600. So again, there's no cumulative cut-off point. So the full €600 gets multiplied by 40%. That's 240. And again, because there's zero tax credit, they pay the full €240. The next week is €900. Again, no cut-off. So €900 multiplied by 40% is 360. And there is zero tax credit, so they pay the full 360. Next following week, €500. There's no cut-off point, so they pay it at the full 40%, which is €200. And again, because of zero tax credit, they pay the full €200. The next one is €500 again. So 500 multiplied by 40% because there is no cut-off point, full €200, and they pay that in full. On the following week, they've gone back onto normal. So what we can see here on the screen is they again got €500. Now you would add all the gross pay to date, and that comes to €6,000. You also work out the cumulative cut-off point. So that would be your 678.85 multiplied by 14 weeks. So even though it's not their 14th week, it's the 14th week in the yearly calendar. And that comes to 9503.9. You take the smaller of the two numbers. So 6,000 multiplied by 20%, and that gives us 1,200. Now over here, there is no tax due at the higher amount. So remember, there will only be tax due at the higher amount should you find that the money that they've earned is bigger than the cut-off point. So over here, the gross tax would be 1,200. So you'd add the two of these together and you get 1,200. Then what you do is you minus the 888.46, and that is the 63.46 multiplied by 14 with a little bit of rounding, and it comes to 888.48. So you've got your €1,200 minus your 888.48, and that comes to 311.54. Now what you do is you add up all the tax that they've paid so far. Alright, so this is what's due, this 311.54, and they've already paid €1,744.20. So that's what they've paid already inside it. So what happens here is you take what they should have paid up to now and you minus the 1744.20, and you get a tax refund of 1432.66 inside it. And again, they would also be due an USC refund because of the fact that it was worked out on 8% on the full amount every single week. And we'll look at that in another video.